Over the past year and a half, I have visited with a whole bunch of clients. Occasionally, I hear them reference another loan officer and another loan company that has promised them that after they do their purchase, they will do a no cost or they'll do a free refinance for them in the future. I'm here today to tell you guys that that is most likely a big fat lie and that there is no free lunch in this business. So I'm going to show you exactly what's going on. We're going to pull the curtains back and show you how this is done, just so that you're educated. I want to make sure that as you're looking at refinancing, and refinances are great things, I want you talking with someone who's going to present options to you, someone you can trust, and someone who's going to get you the very best rate and loan for your situation. So my name's Miles Pitcher. I own Superior Lending. I've been in the business 23 years. I'm licensed in multiple states. Please feel free to use our expertise, our team, to help you with your scenario, even if you're in a state that I can't help you in. Let's get going into this. All right. So first, in any refinance, these are some of the normal closing costs, and some of them you cannot escape, like title fees. They have to happen. But there's usually underwriting fees, title fees, appraisal that may or may not be there, credit processing. You're dealing with your escrow account or prepaids or impounds. That's just, they use different terms for that account, and then prepaid interest. So even though people are trying to tell you there's a no cost refi, there are always costs, right? And in general, there are three ways on a refinance that these costs get covered. Number one, the client can just write out a check for all the closing costs. Number two, you can roll them into your loan as long as you have enough equity in the home to be able to do that. And the equity is basically the difference from the appraised value to what you currently own on the loan. And then the third option is there's a credit given to you by the loan officer or lender, and that credit generally is given to you by raising your interest rate higher than market rates and crediting back some money to you to cover the closing costs. That is how people are saying and claiming this is a free refinance or a no cost refinance. It is not a no cost. It is not free. Okay. It is cooked into your interest rate. So let's go through an example here in a minute where I show you this. I'm going to show you all the details, but I want you to know that there are different refinance types: FHA Streamline, VA IRRRLs, which is an interest rate reduction loan, the USDA Streamline. Those first three are government loans. And when you do refinances with them, where you're not pulling any cash out, you're just working to either shorten your loan or lower your monthly payment / interest rate. They have a very streamlined process and they're awesome and easy to get done. We're very good at getting those done for people. Then there's conventional refinances. Those are your standard traditional loans. We do jumbo refis, and then we also, and this is a little bit different, the construction to permanent loans. You can also do refis where you pull cash out, but today we're focusing on the loans where we're just working on getting a lower monthly payment for the client, lower interest rate, or a shorter term in the loan. So let's go through an example. Here is a scenario. This is not a real scenario, but the rates are very much what we have seen happening over the past year. Client buys the home for $550,000. They put $50,000 down in down payment. Their rate at the time was 7.75 on a conventional loan. Principal and interest, $35.82. And then because they didn't put down 20% equity, they have some mortgage insurance, PMI, and that's $79 a month. And that's in there. We're ignoring right now taxes and insurance because it makes it easier for us to just compare these different options. So one of these other loan officers or someone said, hey, I'm going to do a no cost refi for you. like I said, they're basically raising the interest rate to be able to cover these. So they would come in. The closing costs are going to be around $9,860. That includes setting up the new escrow account for your property taxes and homeowners insurance. And you can see the line here that there's a lender credit. Let me make this bigger. A lender credit that covers all of those. In order for the lender to be able to give you that credit, they have to put the interest rate at 6.99. Okay. What does that do for the client? It saves them $297 a month. That's really good. That's not bad at all. And they have all the closing costs covered. So it's a pretty good option. And remember that on a refi, you will be able to skip 1 month's payment when you do the refi. It's truly not that you're skipping it. It's just built into the loan refinance that it's taking care of that payment for you. So if we factor those closing costs of $98.60, we subtract out that month payment you get to skip, this break even is 1.84 years for this client. It's really not that big of a break even because the client's not paying anything out of pocket or rolling it into the loan. But if you take the cost of the loan, divide it by the monthly savings, it's 1.84. The next option I would have my client look at, or I would show them, is rolling it in. And as long as you have the equity, this is a cool idea. So we take our $9,000 of closing costs, we roll it into the loan. As you can see, the interest rate is much better because as a lender now, I don't have to give that big old fat credit to cover closing costs, right? We're rolling it into the loan. So you can see that even with a higher loan balance, our principal and interest is still better, and monthly savings is around $405. So that's pretty awesome. Again, 1.37 years to break even on that, meaning if you refinanced again or sold the home within 1.37 years, you would lose the money that you'd put into the refinance or part of it. I always recommend to my client that they take that monthly savings that they have, that 405, and they put it back into their mortgage, pay a little extra principal on it. And that way they knock out and take care of all those closing costs that were rolled into the loan. And it really accelerates the payoff. Last option, the client decides they're going to write a check out and pay for the closing costs themselves. Therefore, our loan balance doesn't have anything rolled into it. The client pays for the $9,800 themselves. As you can see, they get a killer rate, and this gives them the largest monthly savings of all the scenarios. This is great, 1.21 years. So as you can see, this is a pretty cool way to go. I'm not telling you that the no-cost way is wrong or not the right way for you. However, I want you to understand that you're paying for that in your interest rate. You could have higher monthly savings, and that would be great. There's other options, but you need to be using a loan officer who's going to work through these options with you and present some ways that fit your scenario. So don't hesitate to call our team if you need any help with this. Here's how you can get a hold of us. Please feel free to reach out. Thanks for watching this video.